This program is brought to you by the Kentucky Small Business Development Center in Louisville. We provide the professional expertise, tools, and resources to help you succeed. To connect with a business coach, call 502 625 0123 or email sbdcinfo@uky.edu. Good afternoon, everyone, and welcome to another Toolkit Tuesday. I'm Janet Flom with the Kentucky Small Business Development Center in Louisville. And we are happy to have with us today Robert Byers III. He's with Woodforest National Bank. He's the Community Development Relationship Manager. Good afternoon, Robert. How are you today?
Hello, how you doing?
Good, good. So April is Financial Literacy Month, and we're getting towards the end of the month. And we wanted to make sure that we offered some content throughout the month, as well as in our newsletter earlier this month, we had some pieces in there. And we thought, what better way to wrap up the end of the month than have Robert on here to talk about financial literacy, financial management for entrepreneurs. So I'm going to turn it over to Robert, and we're going to go ahead and get started. Before we do, though, if you have any questions, we welcome you to put that into the Q&A. You'll find that at the bottom of your screen. If you don't see it right away, just kind of touch your screen or kind of move your mouse. You'll see Q&A there, so you can type your questions. We also have a chat feature open. So if you'd like to just say hello, tell us where you're joining us from today. But we'll answer those at the end, and I'm going to go ahead and turn it over to Robert.
All right, well, thank you. And hello, everyone who's out there. Really look forward to talking and learning about some of the things that you guys are working on as it relates to your business, and also sharing some information. Financial management for small businesses is really the foundation of setting the tone for your small business to make sure that you're going to be sustainable and profitable. So you can have the best idea, you can have the best talents, but if you don't have the structure around financial management, your business will not be successful without having the guidelines that we're going to talk about. So I'm going to jump right into it. And there will be a couple of slides that I will skip over because this original PowerPoint was for in person, and obviously we're doing it virtually. So there'll be some things that we won't be able to do. So with that being said, I'm going to get right into it. So the learning objectives. Understanding financial management and its importance to small business and its owners. Identifying financial management practices, rules, and tools that are available to small businesses, and explaining how financial management practices work and how they're going to help you. So some of the things that this will actually teach you is startup financing, how to finance your growing business, understanding working capital, financing fixed assets. So some of the benefits of financial management. By understanding financial management, you'll know your profitability. You'll also be able to forecast your growth, and you'll be able to plan for diversification, maybe new product lines, and even growing your business to other markets. It also helps you prepare for financing. So if you have that need of borrowing money from a bank or traditional lending, or maybe even a credit union, you'll understand where you stand and you'll be able to kind of move it forward. So the first piece is budgeting. So even before you start your business, I always recommend people to have good budgeting skills and maybe practice personally. So if you can budget personally on personal matters, it will help you to budget for your small business. So some of the discussion points, and this is one of those slides where normally we would be interactive and I would show you a budgeting sheet, but since we aren't in person, we'll just kind of go through this and we'll talk about it. So having your monthly expenses versus what you're bringing in is really the key to budgeting. So not forgetting nothing, not skipping any type of expense as it relates to your business. And that kind of really falls under bookkeeping. So bookkeeping is a very critical component of financial management. You have to organize all your income and expense transactions. The reason why you want to bookkeep is to help you understand your business decisions. It's going to help you with financing. It's going to help you understand when you have to pay your taxes and how to pay your taxes, and then also pay yourself and potentially set you up for when your business has grown, you can kind of start investing in a retirement. So there's 10 basic steps of bookkeeping. First is obtaining a business accounting software. So a lot of CPAs and accountants, they use QuickBooks. You can even use, there's different versions of Excel that you can actually use. The second is opening up a separate business account. And what I've seen a lot of people kind of use their personal account with their business. That's a big no-no. You want to open up an account strictly for your business and only have business transactions in there. And that kind of falls under reconcile your checking account. So that's constantly visiting and making sure that everything is correct and that you're only using your business account for business purposes. I've been in banking for over 15 years. One of the positions I had was a branch manager. And so I would always have business customers come in and they'd have questions about their account. I noticed that they would have transactions on their business account at Chuck E. Cheese or, Gaddy Land. And I'm like, well, why are you using your business account for personal expenses? And that will mess up, a lot of times it will mess up their tracking and mess up what they thought they had versus what they really had. Deposit off sales. So even if you get paid by cash, and let's say, someone gave you the cash, instead of saying, well, okay, I'll put half of it in the bank and because I need half of it right now, that's not going to help you with your bookkeeping. That's going to really not tell the true version of how your business is operating. The next is writing business checks for business purposes. And it kind of goes back to the example I used with Chuck E. Cheese's, only use business funds for business purposes. And it's so easy not to do that. So it's almost a discipline thing. You have to really discipline yourself to only use it for purposes of your business. Obtain a separate business credit card. So not using your personal debit card or credit card, having a business credit card. Pay business expenses first. So before you pay yourself, you want to pay your expenses. So whether that's inventory, whether that's you have monthly bills that are associated with your business, always pay your expenses first before you even pay yourself. Generating and using a profit loss statement. And we'll talk about that a little later. And then the last one is paying yourself with the owner's draw. So when you pay yourself, determine the salary that you want to make throughout the year and stay consistent every 2 weeks or every week, however you decide to pay yourself, make sure that that is consistent and same. So if you say you're going to pay yourself $30,000 a year, make sure that's it, no more, no less, because when you tend to operate and change those payments based on your needs, that's going to take away from your business and it's not going to have accurate bookkeeping. The next piece, really identifying that software. So like I said before, if you know an accountant or a CPA or even your banker, they should be able to help you identify some software opportunities or different resources. Like I said, QuickBooks is the first one that jumps out of my head, and also Excel. Do not use paper to run your business. That's kind of the old-fashioned way of running businesses, is writing everything down in a notebook. But because transactions are virtual and they come in and out so much, you really want to just have some type of software that can keep track, because there may be times where a deposit comes in late night or a deposit is held for a couple of days. If you write it on a notebook, you won't be able to tell when those funds are actually available or being taken out, which is why the software is very important and keeps you up to date and accurate. Next, we're going to talk about financial statements. And financial statements are reports about your business's health and cash flow. There's three basic financial statements. There's a balance sheet, there's cash flow projections, and then there's profit and loss statement. Cash flow projections are also called cash flow statements, and we'll talk about that a little later. So a balance sheet is basically broken down into two columns, your assets and your liabilities. So obviously your assets are the cash you have on hand, any equipment that is worth value, any inventory. So if you're making cakes or if you're making whatever it is that you're making, that inventory is your asset. Now your liabilities are the bills, the owner's equity, things of that nature. You really want those sides, both sides, to be the same. Now, I'm sure it's probably hard to read this particular slide, but it breaks down the balance sheet. So, just I'll kind of go through some of the current assets and talked about it on the previous slide. So prepaid expenses, inventories, accounts receivable, cash, fixed assets could be land, the building, machinery, office equipment. And so when you go down and you look at liabilities, that's accounts payable. So assets are account receivable, liabilities are accounts payable, taxes payable. So a lot of businesses, you have to pay taxes every quarter. So understanding, okay, here comes my quarterly taxes I'll have to pay. Other liabilities, which are other bills that are directly associated with your business. Long-term debt. So that could be if you have a long-term loan with the bank, you're going to have to pay that for the next 7 to 10 years. That's considered long-term debt. Owner's equity is common stock, retained earnings. So that's you paying yourself, but when you pay yourself, you're putting it aside in the savings account. So the next piece of financial statements is cash flow. Cash flow is very important for both yourself, then also for your business, because it helps you understand when you're getting paid and when you have to pay out. And if you understand your cash flow, it will help you manage your money better. So balance of cash received less the amount of cash paid out. Some businesses, maybe they receive most of their money at the beginning of the month, but their bills come out at the end of the month. That is understanding your cash flow. So cash flow projections. This is going to help your company really flow in and out. It will help you provide an opportunity to see what time periods maybe are slower versus what are faster. So, maybe in the wintertime, your particular business cash flows are a little bit different versus when the summertime. So understanding, okay, what time of the year and maybe what time of the month those flows will work for you and maybe against you. Project whether cash receipts, the flows in, will be sufficient to cover the disbursements. So you want to make sure that you have enough money coming in to pay the things that are coming out, and that the money comes in before those things that come out come out. How can you have a cash flow projection, and how does that help? You have to set sales and expense goals. You have to determine a break-even point. So for example, if you had a bakery and you know that it costs you $10 to make a cake, what are you going to charge to make sure that you're going to break even or even be profitable? And I see a lot of times people, they maybe want to have reasonable prices because they're afraid people won't purchase their items, but you really want to make sure that you're going to be profitable, because I've seen so many people have great product, but they're not charging the amount that they need to in order to break even and be profitable. Plan for equipment purchases or replacement or expansion. So if you know your business is going to grow and you have needs to maybe be more efficient to buy equipment so that you can maybe produce more of your inventory, that's something that you're going to need to plan for. Also, if you're looking to expand and grow your business and you're going to have more of a need, that's something else that a cash flow projection can help you with. Determine cash needed to purchase inventory for seasonal cycles, which is what I kind of said earlier. If you know your business is slower in the summer or the winter versus it picks up in the fall or spring, you have to plan for that, and you have to have your finances in order so that it doesn't disrupt any cash flow. Tracking liquidity, and accrual accounting mass. This helps you determine if you have needs for financing. So your cash flow will help you know, hey, maybe I need a line of credit because at the end of the month, that's when all my payments are coming out, but I don't get paid until the following month. So having a line of credit can put cash in your account so that you can pay your bills, so that when you do get paid, you pay that loan back. But it also shows the lenders your ability to plan and repay the financing. So if you don't have cash flow projections, the bank or whoever you're borrowing the money from will want to see that. And if you can't explain how your cash flow is, it's going to be tough for them to give you an actual loan to trust you and have the risk to say, hey, this person can pay me back. This is another chart that may be hard to see, but I'll just kind of briefly read through it. So sources of cash. So cash sales, collection, interest income, loans received, equity contributions. So operating uses of cash. So these are the things that you would use your cash. Contract labor, paying people, wages, payroll taxes, rent, your phone, office supplies, utilities, etc. Non-operating uses of cash. So that could be making sure your debt service is in order, purchasing equipment, taxes again, paying yourself, and purchasing inventory. So discussion point 3, cash flow projections. To increase your cash flow, you need to increase the number of items you sell, or if you're not selling tangible items, maybe increase the service that you provide. Increase your prices, reduce expenses. So reduce expenses, maybe wherever you're buying your inventory from, see if there's somewhere else that you can purchase something for cheaper. Really see who has the cheapest inventory for you. Change the timing of your expenses. Like I noted earlier, if your expenses are coming out at the end of the month, but your cash flow tells you that you have the most liquid assets in your account at the beginning of the month, seeing if you can change your expenses so that you can pay them on time. Save money to have enough opening cash to get through a startup period. So I tell people all the time, if you have a regular 9 to 5 or a normal job, you want to save before you even start your business. So you want to save your personal money so that during the startup phase, you're not struggling and you're not needing additional funding, that you can save it on your own. That's very important. Discussion part 3. So obtaining sources of cash other than sales. That's from a line of credit from a bank, or maybe you have family member or even a private investor, or just a general investor. Reduce the change of timings of your draw. So maybe if you're going to pay yourself once a week, maybe change that to once a month, and because that could potentially help with your cash flow. Buy inventory from the vendor at a lower price. So we kind of talked about that as well. Obtain credit from the vendor. So there's some vendors that will say, hey, I'll give you your inventory and you can just pay me 30 days or 60 days later. That would also help with your cash flow. Establish a policy to get paid sooner by the customer. So if they're, for example, I'll use the catering business and the cake. If you have an appointment to where you have to do a cake, making sure you get paid not the day before the cake is going to be delivered, but maybe a week or two. So understanding when to charge your customer and how soon you can get your cash. The next piece is profit and loss. So profit and loss measures revenues and expenses over a period of time. This tracks profitability, whether the business is making a profit on what it sells. So the P&L is what banks and most traditional lenders, this is what we hone in at. We really look at, okay, is this business profitable, and is this business profitable over time? So you may be profitable for a couple of months, but are you going to be sustainable? So understanding your profit and loss statement is very important for not only the bank, but for you, because this will determine, will you need to increase your prices, or will you need to add other types of products or services to your business to make sure that you're profitable? Do you need to change some of the products and services that you have because maybe it's not making you enough money over time? So all of those things are very important as it relates to profit and loss. The PL statement shows how successfully the buying and selling process is that you manage. So you may be buying things and not selling it and not getting enough profit. The P&L is going to really help you with that. This is also a software program that you can have where you don't have to physically do the equation to determine that. As long as you're putting in all your deposits and all your bills, the P&L statement will form itself. It also measures the ability for your business to grow and repay debt service and support you. So, the P&L will show you, okay, year over year, month over month, this business is growing, or Are you staying flat? Is it a flat line? So P&L really tells the story about your business from a financial standpoint. And here's the formula for profit or loss. So it's sales minus the cost of a good equals the gross profit. And then once you have that gross profit, when you subtract your overhead, which is rent and other bills, that gives you the net profit. So the net profit is really what your profit is. A lot of times people want to reflect on the gross profit, but that's not real. That's not the real profit because you still have to pay overhead. So understanding that your net profit is what the bank is going to be looking at versus your gross profit. Because a lot of times gross profit, it looks great. You can have a gross profit of $1 million, but then if you're, let's say you have overhead of $500,000, you're really not making $1 million because you have that overhead that you have to pay. The next, what is the basic formula for profit and loss statement? Your owner's draw, so that's you paying yourself. Future expansion and equipment, principal loan repayments, and income taxes. These are all things that I've kind of explained and talked about previously, but yeah, these are the things that you want to pay with the net profit. How do I compare a profit and loss statement? It's easy. It's like I said, it's part of business accounting software. It's in QuickBooks. There's Excel sheets where you can put in the equation. So there's easy ways for you to determine your profit loss statement without you having to manually do that. And that's, that's the great function of the software that we have out in today's time versus trying to handwrite everything. So discussion point 4, profit and loss. These are all questions you need to ask yourself when you're reviewing your profit and loss statement. What do you see? Is the business well managed? Does any problem stand out? What about potential growth? Will the business support the owner? Can you pay yourself? Will you be able to pay a loan? So that's what you're really looking at when you look at profit and loss, all of these things. So when it says, what do you see? If you're noticing that you're paying a lot more for your inventory items and you're not really getting that return like you need to, that's going to show in the profit and loss. Business financing. So this is the fun part. This is where you're determining, okay, how am I going to finance my business? Financing is getting the money you need to start, operate, and grow. So equity financing versus debt financing. Equity financing is having maybe an investor, a private investor, a hedge fund, or just an investment company that's willing to invest in your business. Versus debt financing is receiving a loan from a bank or a loan from a credit union or any CDFI, Community Development Financial Institution. So a lot of times it may be hard to get equity financing because investors aren't really just wanting to throw their money out without understanding how much they're going to get returned. So the most common way of getting financing is the debt financing. And then financing working capital versus fixed assets. So working capital is day-to-day expenses that you will have that you need to finance to maintain your business. Fixed assets are, assets that are going to help you over time, over a longer period of time, that will help you whether you're trying to retire or expand your business. Do's and don'ts for small business finance. Invest your own money. Like I said before, if you're not working for yourself and you have a regular job or you're working for somebody else, constantly save that money for your business. Earn the right to borrow. I see so many people who want to open up a business, but their credit isn't good. So you want to fix your credit, your personal credit score, before you really want to open up a business. If you have bad credit and you're going into business, that's going to be a struggle if you're needing financing. Show profitability. So show that your business is going to be profitable. And, we just came out of a pandemic. So understanding potential hurdles or obstacles for your business. Are you willing to pivot your business so that you can remain profitable? During the pandemic, there was no in-person. So if you have a product or service that relies on being in person, how can you pivot to make sure that your business still stays afloat and you're selling your products? Understand and keep working capital. So that's making sure you have maybe a business savings account or just capital in the account that's going to keep the engine going, keep your business running, keep you flowing. Be lean on fixed assets, match sources and uses of funds. So, you don't want to buy expenses that's not going to really provide any revenue. And I'll give an example. You can buy the fanciest chair, computer chair that costs $300, but is that computer chair helping you gain business? No. So in my eyes, go to a thrift store and just get a chair very cheap instead of spending $100 on a chair that's not going to help increase your revenue. So understanding that, because I think so many people, they spend money on their business, but they spend it on things that maybe aren't going to show profitability directly from the business. So understanding that difference is very important. Business financing. So what are the do's and don'ts as we continue? Understand your financial statements. A lot of people, they have their bank statements and they say, hey, I'm making $4,000 a month according to my bank statements. But what does that really look like as it relates to you being able to pay on a loan? Are you going to be able to afford paying additional debt? Understanding collateral options. If you need other type of collateral, are you willing to use that to kind of help fund the loan or fund whatever it is that you're trying to get? Understanding risk and cost for loan types. So there's different types of loans you can come out with, but they all have different rates. They all have different time frames and terms. So is a loan for 5 years going to be better for you versus a loan where you only have to pay for 2 years? Is interest only payments going to help you, or is principal and interest payments going to help? So just understanding what type of term and what type of loan is going to be the best fit. No grants. So some people rely on grant funding, which is money that you don't have to pay back. So maybe getting grants is great, but not relying on just grants. Shop around. I tell people all the time, go to several different banks, go to credit unions, go to CDFIs, community development financial institutions, and then get expert advice like the people here at the SBA or the SBDC. They have coaches that can help you understand and teach you the best options for financing. So use those experts, even go to your personal bank and ask the manager, hey, what do you suggest? Get different opinions about what the best financing is going to be for you and your business. So loans, getting ready for loans, having a business plan. This includes a profit plan. So not only having a business plan, I think a lot of people, when they write business plans, they say, okay, this is how my business is going to make money, but they only give it in a perfect case scenario. Also include in your business plan, worst case scenario. What is it going to look like if something happens within the where you're at or the industry, having those options, because banks, we look at lending as a risk. We're risking giving you money, and are you going to be able to pay it back? So if you have worst case scenarios in your business plan, that's going to help the bank be more relaxed and be more comfortable, because we see that you've already planned for the worst case scenario. Whereas if you have a business plan and everything is just perfect case scenario, and then something comes up and it's an emergency, we can't really help you. So that's key. And that's one of the biggest things that I see when business plans is a lot of people don't give worst case scenarios. Know what you can afford. So there may be products, there may be things that you really want, but can your business really afford that? And being humble enough to know, hey, I don't need a company van that's a 2020. I can get a company van that's a 2008 because that's more affordable. Study your financial statement. So really understand how you're making money and when you're making money. Check your credit report. Like I said before, you really want to build your credit and have a great credit score so that will help you finance. Establish collateral options. So if there is equipment or other type of collateral opportunities, utilizing that to the best of your ability to get the financing. And then show your equity contribution. So if you come to a bank and you say, hey, I've been saving for the last 5 years to really start this business, and I've been putting money from my personal income over into the savings account specifically for the business, that says a lot. That says that you're really serious about, really trying to grow your business. Research your financing options. I've kind of mentioned this several times, but CDFI, Community Development Financial Institutions, are organizations that the average person does not even know about, but they provide lending and they provide financing just like a bank, but they don't have some of the same guidelines because they're set up as nonprofits. So really understanding all options that you have. There are lending options that you can get from the government, your local state, local county, really finding other options outside of just traditional banking. The loan package. So this is normally what a loan package includes: a business plan, which we've talked about, business financial statements, personal financial statements, personal and business taxes. So we look at your business statements, we see how money comes in and out, but then we also look at your personal statements because we want to see, are you wasting personal finances on things that maybe aren't worth spending money on? Because if you're doing that personally, 9 times out of 10, you may be doing that for your business as well. And then with the tax returns, I see so many business owners, they want to show losses on their business because they're looking forward to a refund check. They're looking forward to get a tax refund. Sometimes is the tax refund worth it? No. So if you're not really having those losses, don't show them. Show them, I'm sorry, because getting a $5,000 tax refund may be okay, but then if you're in a situation where you need to borrow $50,000 from a bank, and we see that you lost all this money on your taxes, it's not going to really hold well, and it's going to be hard for the bank to really approve you. So I think that's a big myth that a lot of small business do. They want to show losses because they want to get money paid back through taxes. But if you're at a point where you're going to need to borrow money, some of those losses may hurt you in getting that financing. What are some other elements? So source and amount of equity contribution, credit report, collateral. These are things we've all talked about. Purchase agreement, appraisal. Something that's not listed on here is being a personal guarantor. So if your business may not have the funding it needs as a business, do you have a personal guarantor that you can add to the loan package? So that's someone, maybe their personal finances look a lot better than their business finances. Do you have an investor that's willing to put their name on the line to help you get the funding? Qualifying for a loan. What are the criteria? A good credit score, equity contribution. We've talked about all these things, repayment ability, and then loan to value. So your loan to value ratio is very important. Do you have enough money to pay the loan, but still also have enough to be operating your business and grow your business? But these things are what a lot of banks, if not all banks and credit unions, look at first off. So if you have issues with any one of these things, you probably want to work on that before you reach out to try to get a loan, because this is the foundation of what banks and lenders look at. And we look at it not on a personal, we're not taking it personal to you. We're just looking at it as a risk level. Is this client going to be a high risk to the bank? That's how we view loans. Startup financing. So this is, like I said before, saving money from personal income for your business. Sweat equity, that's more so in housing. So, let's say if you're flipping houses, instead of paying someone to do the remodeling inside, you do that yourself. So you do the own thing yourself as opposed to paying for it for someone else to do it for you. Business credit cards, and then family. Maybe your luxury, you have family members that can help you with financing. Maybe they can give you money. Maybe you can borrow money from them. If not, identifying investors and identifying organizations within your community that may help you with financing. So these are a couple of places where you can look for a loan, and I think we've mentioned them. So banks, regional lending organizations like the SBA, Like I said, community development financial institutions, credit unions, local government organizations. Those are all places that you can go to potentially get a loan. So key points to remember: financing is getting the money you need to start, operate, and grow your business. You always want to start off by creating a budget and monitoring your expenses. Sound bookkeeping is the basis for all financial management. Purchase and learn how to use financial management software. There's three types of statements: balance sheets, cash flow statements, and profit and loss statements. These statements provide a compelling story to describe your business. Separate your personal and business records and funds. There's factors that affect your ability to get a loan: your credit score, equity, repayment ability, and loan to value ratio. So these are all things that hopefully you've got a better understanding after this class. Any questions? I've kind of went through the process. Let me know if you have any questions or concerns. I'll turn it back over to you, Janet, to see if there's any questions.
Yeah, actually, we have several questions. So we're going to kind of step back, and some of these questions might have been answered as you move through the presentation, but I'm going to go ahead and ask them anyway. So we have a question about the difference between an owner's draw and just getting a regular paycheck.
Really, there's no difference. The owner's draw is if you're the only person that's going to be getting paid. So if you're starting a business and you don't have any other employees, the owner draw is the only one that is going to show up basically for payment. But if you have people working for you, then the owner draw will fall right into the payroll department. So a lot of times payroll consists of contractors and other people working for your business. Owner draw is just you paying yourself personally. So hopefully that kind of helps clarify the difference.
Okay. And does a P&L statement include payables and receivables?
Yes, they absolutely do. Yes. And a lot of the software, they will have that broken down and they will show you that.
Next one is, what is the best place to park working capital during the high profit times?
Well, I'd say there's several options. A business savings account. There's also other types of investment accounts. But the only thing with those investment accounts is that sometimes they want you to have that locked in for a certain amount of period. So if you know that you won't have a need for those funds, then those investment accounts, which will have a little bit higher interest rate than a general business savings account, would be an option. Another CD. So let's say that you have funds and your downtime is going to be in the winter season. So if you do a CD for 3 to 6 months, once that CD comes due, then you can have access and it's liquid. And when it's downtime, that's when you use the funds from the CD. So, I recommend a savings account, CD, and just really talking to your banker to see what other accounts they have specifically that, still has somewhat of a liquid opportunity for you to get it out whenever you need it.
Okay. There's a question on, is there a set formula, strategy, or technique you feel is best for price setting?
Yes, and they actually, depending on the industry that you're in, they actually have online. There's different formulas, algorithms is what we like to call them, or equations that really helps with setting, your price point. And what I also recommend is whatever industry you're in, go and ask other people within your industry. And I know some people may say, oh, that may be a little bit uncomfortable talking to my competitors and asking my competitors questions, but a lot of times they can help you understand what that price point should be and maybe learn from their mistakes, because they may say, hey, starting off, this is kind of how I set my price point and this is how I found that, but then I realized that wasn't going to be profitable, so I switched it around. So really researching your industry and understanding maybe how your competitors or people within your industry set their prices as well is very important. And a lot of times just going into those actual businesses and just kind of breaking down, looking what they do, and then kind of compare that to how you operate.
Okay. What are the best payroll management systems for small businesses?
I would say, and I can't say one payroll service over the other, but I know a lot of banks, they either partner directly with a payroll company. And a lot of times, even now, so merchant services, which is your debit card or credit card machine. So a lot of times, if you receive payments through a debit card or credit card, they also have payroll options within the merchant services. So I would really ask your bank, maybe if you have a merchant services. I know a lot of people like to use the Square because you can put it on your cell phone, but there's other merchant services that actually provide more payroll options than the Square. So just really kind of exploring through your bank and just really Googling and reaching out to see what other merchant services or payroll services are provided, because they're all going to be competitive with each other, but the biggest thing is what benefits and features that the company has that's going to best suit your type of business. So if you're in one industry, a payroll company may not really have that type of leverage for your industry versus a different payroll company. It's really all about how you get paid and managing that cash flow.
Okay. How does it look if one's losses just breaks even on their taxes? How's it?
Well, it depends on why you had those losses, I guess.
Okay.
If it's losses that are out of your control and it's maybe losses due to growth of your business, the banks, we can understand that. But you have to know why you had those losses, and you have to be able to explain to the bank why those losses are what they are. And to draw even, that's fine. So I'll give you a couple of examples. So let's say you're a contractor or you have a business, and for whatever reason you didn't get paid from a vendor that you did services for, and that's going to provide a loss. So you can say, hey, I did my part, but for whatever reason they didn't pay me, so I'm having to go to court to try to get it, or what not be. But if you're showing losses because you're not managing your products and services correctly, then the bank is going to look that in a negative tone. So just really understanding why you have those losses to make it even, and being able to explain that to whoever it is that you're trying to borrow money from.
Um, Someone mentioned that you had mentioned a nonprofit entity that supports small businesses with lending. What was that
So
again?
yeah, the CDFI, so
Okay.
community development financial institutions. And I can name a couple here within Kentucky, in Louisville. So in Louisville, there's L Home, which is a CDFI. There's Community Ventures. Community Ventures is based out of Lexington, Kentucky, but they do things all around the state. There's also Louisville LISC, LISC. So Louisville LISC is a new CDFI that's actually
Hmm.
growing within Louisville. There's other nonprofits, Render Capital, Access Ventures. So all of these organizations that I just named, not only do they help small businesses, but a lot of times banks will lend them money or give them money to specifically re-lend to small businesses that maybe don't have the financials or the credit scores to get a traditional loan. So the bank I work for, we do a lot of lending to CDFIs, but we tell them, hey, if you could use these funds for those who aren't able to get a loan directly from us, that would be great. So if you're in that in-between phase where maybe you haven't been in business for 3 years, because most traditional financial institutions want you to be in business for 2 to 3 years, or maybe your credit score isn't what it needs to be, then the CDFI may be a better fit for you.
Okay. How is the owner's draw taxed as opposed to owner's payroll tax?
It's pretty much the same. The only difference is the owner's draw, you have to show that on your finances. And when you have an accountant or when you go to do your taxes, they'll see that line for the owner's draw, and they just read it as payroll. So it's pretty much the same. There's really no difference in how it's done. They're going to do the same percentages when you get your taxes done, whether it's payroll or owner's draw. I think owner's draw is just more of a terminology, like I said, for you to just pay yourself, but it's no different when you do your taxes.
Okay. Um, so do you have any recommendations for small business accounting software? We're being asked.
QuickBooks is the best one I've known. And if you go into Excel, if you have somewhat type of experience with kind of payroll and managing financials, there's different opportunities within the Excel's workbooks where you can actually customize a financial management sheet to set up your payments, your cash flow, and things of that nature. But really, the one that does it for you, I recommend is QuickBooks. And if you don't know of any others, I would just reach out to maybe a local CPA or a local accountant, because a lot of times other they have other opportunities that they could share with you that maybe aren't considered mainstream to where you can just Google it. So as a business owner, you really want to have a good partnership with the CPA, a lawyer, and a banker anyway. So having that CPA relationship will allow you to get maybe some of the tools and resources that you won't be able to find on your own. So that is something that I think every business owner should have: good relationship with a lawyer, CPA, and a bank.
Excellent. I think that yes, looks like all of our questions. So Robert, I did have folks want to know if you would be willing to share your slides with them.
Yes, I will. What I'll do, Janet, I'll email it to you, and if you could
Okay.
forward it to them, that'd be great. And
Okay.
yeah, feel free to, if you have any other questions, feel free to reach out to me directly. My name, Robert Byers. Phone number is 502-216-3113. Again, 502-216-3113. My email is RBYERS@WOODFOREST.com, rbyers@woodforest.com. And Jenna, I think I saw
Yeah.
uh, another question in the Q&A just popped up.
Yes, just popped up.
Okay.
So this person is a contractor. The question is there a benefit to keeping track of income/expenses for each job and only paying the expenses for that job with that income? Or can the income just be used for the current expenses?
I recommend having that particular job, having the expenses just for that particular job, because every job is going to be different. And if you generalize all the jobs into the same, then that kind of mismanages the funds. So yeah, each specific job should have its own budget, its own financial profit and loss or income statement. So yeah, definitely don't just generalize it, because that can cost you to really waste money on a job that you really don't need to waste the money for. So yeah, each job should be within its own budgeting, if that makes sense.
Excellent, excellent. Yes, so everyone, we will, I'll send out an email tomorrow that has the slides, the recording. We'll send a link that will ask you to do an evaluation for us today, as well as follow up with Robert's direct email. So again, you can have all of that in one place. We'll send that out to you tomorrow. Looks like that's it for us. Thank you so much, Robert. We had a lot of great questions, and we look forward to having you with us again in the future, if that's great.
Yeah, definitely. Look forward to it.
Excellent.
Awesome.
Everybody have a great week, and thank you all again. We'll see you soon. Thanks, Robert.
All right. Bye-bye, everyone.
Bye.